The Fed is doing unprecedented liquidity measures and credit measures. We believe that this is probably the main reason why growth stocks are doing so well, and we want to talk about this a little bit more. This is the Not Even Wrong podcast. It's July 20th, 2020. This is Krimdelko. Today, the fund is up 18%. The market is roughly flat. For the year, we are up 149%. The market is roughly flat. So that means we have, if we started with $100 in January 1st and the S&P would have had $100 in January 1st, we would have now $249 and the S&P would be roughly flat. It would be at $100 still. So the main performance today and for the year comes from Tesla. We also made some money with the CRISPR index. We made money with Microsoft, with our Intel calls. We are slightly down on our RTX calls. Now, what happened today is, I think it's a good segue into the topic of the episode. Today we had an outperformance of the growth stocks, the disruption stocks, stocks like Tesla, Amazon, Square, Shopify, Lululemon, stocks that grow, organic growth, real disruption, that kind of enterprise was bid up today and massively. I mean, we had an outperformance by the NASDAQ of 2.5% relative to the flat market. So clearly, there is definitely some money flowing into this space. And let me talk about this. I think this is directly related to what's happening with the Federal Reserve. Now, first of all, what's going on with the Federal Reserve? So we had this COVID crisis outbreak in March, and the Fed took a lot of action to put liquidity in the market. And I want to segment into three things that the Fed typically does in a crisis. Number one, they start lowering interest rates. This is the traditional thing that the Fed does, lower interest rates. Second, they provide liquidity to risk-free markets such as treasuries and maybe some very, very safe inner banking type markets. And third, they start providing credit to banks and non-banks. And this is something that the Fed can do. It's called the Federal Reserve Act, Section 13.3, which was given which was ratified in 1932 under President Hoover as an extension of the Great Depression measures that were back then in place. So what happened in 1932 was the Congress and the president said, listen, Fed, you are independent. You can turn interest rates up and down, but we want you also to give money to the economy, directly provide money to the economy. And this is what Federal Reserve Act 13.3 allows the Fed to do. So we had a similar situation in 2008 when Ben Bernanke, the Fed chef in 2008, decided to buy mortgage-backed securities. This was exactly something that this Federal Reserve Act 13.3 allows him to do. Today, Jerome Powell does the same thing. He chooses several facilities to provide credit to banks and non-banks. So the non-banks means companies, regular companies. And on top of all of that, there is what's called the CARES Act, which is a stimulus package that Congress passed in March, a 2.6 trillion package, which allows the Fed to give money directly to companies by buying corporate bonds and potentially even ETFs, so even buying just equity. The whole idea of all of this is to lower the financing cost of companies. Or more conceptually, what the Fed wants to do is entice risk-taking by lower the opportunity cost of money and give people, risk takers, the ability to access money and start doing something with it. Or in technical terms, increase the velocity of money. What's the point of throwing money at the economy when everybody just puts it under their pillow, or in modern terms, just buys treasuries, or even worse, buys gold and things like that? What we want is people to start taking risk. Now, what's happening in the first phase is that most people aren't taking risk, but the money is still flowing, and it's flowing to the companies which took the risks before this COVID crisis happened. So the companies which took risk and succeeded and are what we call disruptors, they are the beneficiaries of this. They're the first phase of beneficiaries. So Tesla, which is up 5 times since the lows of the COVID crisis, Shopify 5, 6 times, Square about 3 times, 2.5, 3 times, so on and so forth. These companies are beneficiaries of this money which is flowing into the market and going to the risk takers, but not the new risk takers. It's the risk takers which have been there before. Hopefully, at some point, new risk takers will show up and start doing more interesting things. And I've spoken about this before. For example, we have a low discount rate now for pretty much any project. So we expect more investments in things like climate change, renewable energies, social investing where we can start closing the income gap. Let's say Square is a good example of that, giving people access to banking, allowing transactions to be smaller, less bulky, more granular, that requires more investment, but also allows more people access to banking and financing, and therefore closes the gap between who can actually take risk and who can't. So having said all of that, what I'm trying to get across here is that we have a situation in the market where lots of liquidity is being provided to the market, and the first beneficiaries are the growth companies. Tesla is one of them. And hopefully later on, we'll see more beneficiaries in the non-disruptive, non-Silicon Valley style economy, where normal people maybe can open another restaurant or a parlor for barber parlor or things like that. I don't know where it's going to be, but I'm just hoping that the discrepancy between the haves and the not haves will not increase as much as it is increasing now, because right now it's increasing dramatically. Whoever is invested in the growth economy is benefiting from capital inflows. Who isn't is not benefiting. And that gap is widening, and that's not good for society. So I hope that the Fed, by its own statements, is right. And the Fed is saying we are doing this to increase the risk-taking capacity of the economy, hoping that therefore we can increase economic growth and employment. We had the discussion today in our fund meetings. We had several meetings today about this, and we discussed a couple of questions. One is this good for the economy? Is this a problem we should be concerned about? The answer is yes. We don't want too much discrepancy in the economy. However, we're also not concerned in the sense that we are at the right place at the right time. So we're making money as a fund, but we don't want society to suffer. We want to make money in a healthy society. So we hope that the Fed's policies don't turn out to be a Pandora's box and create a lot of problems, but that they will end up hopefully solving some of the economic and social problems that we're facing. Another question we had, which is not exactly related to the Fed, it's the question of which is the company you can make money with by investing in AI. And the answer to that is it has been an NVIDIA so far. When we started to look at NVIDIA as an AI company, the stock was 20. Now it's 450. So we had a 20x, which is clearly by far the best investment you could have made in almost anywhere, particularly in tech and in AI. I think this is changing now. I think Tesla is going to become the AI company of the present. People will start buying Tesla for its AI capabilities. We're not there yet, but we're getting there. And this is a whole nother episode, and I already had an episode about the AI of Tesla. I spoke a lot about why we think Tesla is very well positioned to become the AI company of the decade, if not even more. I just want to reiterate our conversation that we had in the meeting today about which company can be the AI company of now and the near future. And we believe that Tesla is definitely high up on the list. Right now, it's still NVIDIA, but I think there is going to be a change of guard. So to come back to the thesis of the episode, and to summarize, we believe that the Fed, through its several facilities that it's triggering under the Federal Reserve Act 13.3 is providing liquidity to the market and credit to the market, and that a lot of that money is flowing into growth sectors as investment and lowering the cost of financing for those companies, which hopefully will trigger their growth and increase their growth, but also hopefully trigger down to other companies and increase the ability for other parts of society to take risk and participate in economic growth. That would be a good scenario, and we're hopeful that there is a chance that that scenario will materialize. Thank you.